In this video, I will walk you through a complete guide to understanding trends. You will learn 3 different ways to identify trends in the market. First, we will focus on pure price action and how it reveals both trends and potential reversals. Then, I will introduce a couple of price action-based indicators that help visualize trends more clearly. Finally, we will look at momentum and volatility tools that can support your analysis. Let's begin with identifying trends using price action alone. At any moment, the market is either trending or moving sideways. When a trend exists, it can be upward or downward. In an uptrend, price generally moves higher, while in a downtrend, price generally moves lower. However, price never moves in a perfectly straight line. There are always temporary moves against the main direction. For example, even when the overall direction is upward, there will be short periods where price pulls back. This creates a structure where price pushes higher, then retraces slightly, and then continues upward again. Because of this behavior, an uptrend is defined by a sequence of higher highs and higher lows. Each new high is above the previous high, and each new low is above the previous low. This repeating pattern forms the foundation of an uptrend. As long as this structure remains intact, the market is considered to be trending upward. You can also draw a trend line by connecting the higher lows. This line does not need to be exact, and it can be treated more like an area rather than a precise line. The key idea is consistency in higher lows. As long as price continues to create higher highs and higher lows, the uptrend is valid. But if price fails to create a new higher high, it can signal that the trend is weakening. For instance, if price attempts to move higher but cannot exceed the previous peak and then starts to fall, this suggests a loss of strength. At that point, the trend is not yet broken, but there is a warning sign. The structure officially breaks when price drops below the most recent higher low. Once that happens, the uptrend structure is no longer valid. This increases the likelihood of either a sideways range or a full reversal into a downtrend. In a downtrend, the opposite structure forms. Price creates lower highs and lower lows. Each peak is lower than the previous one, and each bottom is also lower than the last. This consistent pattern defines a downward trend. As long as price continues forming lower highs and lower lows, the downtrend remains intact. The structure breaks when price rises above the most recent lower high. This suggests that bearish momentum is weakening and that the market may shift into a range or begin a new uptrend. So far, you have learned how to identify trends using price action. If you see higher highs and higher lows, the market is in an uptrend. If you see lower highs and lower lows, the market is in a downtrend. If neither structure is clearly present, then the market is likely ranging without a clear trend. Now let's look at 2 indicators that are based on price action concepts and can help you identify trends more easily. The first indicator is called Trend Lines version 2. After adding it to your chart, it automatically attempts to draw the most relevant trend line based on current price behavior. If a clear trend exists, the indicator will display a line that reflects that direction. This can quickly show whether the market is trending or not. If the market is moving sideways without a clear structure, the indicator will not draw a meaningful trend line. This absence itself is useful, as it suggests that there is no strong trend present. The second indicator is called Adaptive Trend Finder. Once applied, it identifies the current trend and draws a channel around price action. By default, it focuses on the short-term trend. In the settings, there is an option to switch to a long-term channel. When enabled, the indicator adjusts to show the broader market direction. This allows you to view trends from both short-term and long-term perspectives, which can be very helpful when making decisions. Now let's move on to momentum indicators that can support trend identification. The first one is MACD, which stands for Moving Average Convergence Divergence. To make it more suitable for trend analysis, the settings need adjustment. Set the fast length to 100, the slow length to 200, and the signal length to 50. Then remove the MACD line and signal line so only the histogram remains. With these changes, the histogram becomes a clear trend tool. When it is above the center line and colored green, the market is trending upward. When it is below the center line and red, the market is trending downward. Next is the CCI, or Commodity Channel Index. Despite its name, it works across all markets. For trend identification, set the length to 100. When the CCI line is above 0, it indicates an uptrend. When it is below 0, it signals a downtrend. This makes it a simple but effective confirmation tool. Finally, let's look at a volatility-based indicator called Pivot Point Supertrend. This tool uses ATR in its calculation and improves upon the traditional Supertrend indicator. When the line appears above price and is colored red, it indicates a downtrend. When the line is below price and turns green, it signals an uptrend. This visual approach makes it easy to quickly identify the market direction. In this video, you learned 3 main methods for identifying trends. First, you explored price action and how market structure defines trend direction. Then, you saw how price action indicators can automatically highlight trends and channels. Lastly, you used momentum and volatility indicators to confirm and support your analysis. That covers everything for this guide. If you have questions, you can review the concepts and apply them directly to charts to build confidence and consistency in recognizing trends.